Okay.
Go ahead.
At the beginning of the presentation, I mean, you show, the returns of like small cap, nano cap, mid cap, large cap over last year.
Yes.
And so you can see that in the nano cap and the small cap base, some of these stocks really, they run 200%, 150%. Um, is a like a trend tracking methodology or strategy good for these small and nano caps? If you can capture one of these long trends.
Yeah, yes and no. There's a good thing and there's a bad thing because most of these, like nano and micro cap, and even the small cap, they're not followed, right? There's no analyst who's gonna take the
Yes.
time to do any type of research unless which I've seen, and I know you're familiar with Jean-Claude, that they're kind of a captive analyst. Like when they do these promotions, let's say it's a biotech company, or I've seen it with batteries, right? They go around the country, they have these investment conferences, and they bring their own analysts. An analyst says, oh, we put a buy rating on this. This is a $3 stock, for instance. And then CEO talks and said, well, I want to bring my analyst. And then you find out this analyst had been given, 100,000 shares or whatever it was. So majority of time they're not followed. So it's more of a really, you have to do a lot of studies. And one of the things about these nano and micro is either you have to really know how to analyze, and it happens a lot with the biotech and technology stocks, or you have to have a fund of them, like 10 or 20 stocks, because out of 10, nine of them might just go belly up. So one becomes a big winner. And uh, obviously, you have like the ETF, like for microcap, you have IWC. IWC is the ETF for the microcap, so you don't even have to think about it. So if you would have owned that, obviously you would have done well. But other than that, there is no, I mean, they do have their own analysis, and it goes back to, let's say, Henry's suggestion. There is a special way of looking at, let's say, some of these really nano cap that they don't have a lot of funding. They do have maybe some, they have a good story. They could be taken over. There could be something that, on the other hand, I've met with some CEOs that the job is they just sell a story, and then they're hoping by selling that story somebody's going to take over the company. There's not really a fundamental idea, it's a theme, and they kind of promote themselves to be bought out. So, and then a lot of time it fails. But from the chart point of view, though, I do have a few ways that I think I will share that. Which sometimes you see these big moves at these nano companies, and I can share how we can make sure that um, they're basically real, and there is going to be a leg rather than being pumped. So, but it is pretty risky, Jean-Claude.
Okay.
A lot of these companies, they don't really have a lot of fundamentals. They
Yeah.
usually burn cash so fast that they always are starving for funding most of the time.
Right.
So it's important to do a lot of due diligence in these. So either
Mm.
you have to have a large um, portfolio of them, or you really have to do a lot of homework. I mean, I'm just got um, I'm looking at a couple of biotech company right now. I'm analyzing them, their phase one, phase two. There's just so many of them around, and then they look for investors, and then you just have to do a lot of due diligence with
Mm.
these. So you don't really have a lot of numbers. You're basically trusting what they have to say, but then you end up with some really diamond in the rough, and then they can be they can be magnificent. And it's not unusual. I mean, I've been fortunate enough to see, and I've been unfortunate enough to see that companies go belly up and they sold you a lot of stories. But I've had companies who've been up within a year, been up 1,000, 2,000%. And that's really fun to see that happening. And it could be mine was actually wasn't in biotech. I mean, one of my first experiences with a gold miner in Canada, and that worked out really good. And then they were taken over. They got so good. So, but yes, these are the problems with these small
Yeah,
cap. As you know, there's no mutual fund or hedge fund wants to touch them, so you
exactly.
don't really have that the volume or the interest. So you
I'm
hope they
just
will get there someday.
yeah, I'm just thinking because it's not so followed, there might be some inefficiencies there that could be exploited.
Absolutely. No, there is a big inefficiency. The same thing with small caps, Jean-Claude. So you can have a happy medium and maybe find some of these small caps that there maybe 3 or 4 analysts follow them. And you
Yeah.
do have some history. And even so one thing is before I let you go is that's what I do. One of my criteria is you have to remember that the fund managers, so that's why I look at stocks over $5 because a lot of institutions they're not going to invest anything in $2 or $3 company. But after $5, there are specific, let's say, Fidelity small cap. Then they start coming to picture. The nice round number is $15. $15 brings the institutional interest. And because there's institutional interest, there's a research analyst interest. So when there is that analyst, and then you have this the volume upbeat and then that interest. So that's the reason stocks under $5, especially if they're not the companies who were like used to be 100, now they're 5. But the companies that they've been growing, once they hit that $5 threshold, then you see they quickly go. If they're a good, fundamentally good company, they go from 5 to 15 at no time. And that's what you should look for. And that's one of the strategies you could use. Maybe stocks that they've had a long base at a
Mm.
weekly for the last 2 years. Maybe they're in the squeeze or ball. And then they break out, and the breakout is above 5. Watch for that because a lot of funds they have the computer programs. They look for something because their investment policy, let's say, doesn't allow them to buy stocks under 5. Now, great. Now they can actually go in, and they've been waiting for this, and they start, doing obviously dollar cost averaging their own. They do VWAP, and they use the volume weighted average pricing for over 3 months. Because a lot of funds, as you know, it's like they don't buy at once; they just accumulate over time. But
Mm.
watch for that. That's what I watch over $5 breakouts. So
That's a great
I
idea.
hope
Thank
it's
you, Ramin.
helpful, of course.
So
Okay.
Ramin,
Any other question?
yeah, I have a
Yes,
question
Sean.
about the trade of the week. Um,
Oh, yeah.
yeah, when I look at the Momo, I didn't see it bounced a lot back. I think it's just slightly 3 days. So I think to do that strategy, we have 3 ways to exit. One, it's like you set the 25-50% the target. Two, it's we wait till, for example, till the January 12th or 15th, and then just exit whatever at that time or when the options expires. The third way would be we look at the price chart, maybe find the next resistance. Once it's bounced back to that resistance, we can exit. I don't know whether you did a study which one works best, because to me it looks
Yes.
like it bounced a little bit back, but if we exit now, we might lose the huge buy purchase in the new year. I don't know whether
Oh,
that.
absolutely. No, no, no. You're absolutely right. Okay, let me just clarify. These tax selling, they are nothing to do with really fundamental analysis or even technical analysis. The whole criteria that it is supposed to be with the human psychology for the first 10 days or 11-day trading of the month. That's it. So what I did usually doesn't happen. I just want to share with you. It should have happened next week, for instance, me getting out of my options, but it happened now. What I want, so the whole idea is usually these losers, they bounce the first 2 weeks of the year. That's it. If they don't, you let the options expire. That's it, period. No, the resistance or other things you can look at it. No, the idea is I have my target, and basically I bought these options, and listen, 11th of January is here, and that's what the clock is ticking. So it should have happened between now and 11th or 12th of January. So it happens once a year, and it's purely is based on emotions. And so I just want to share that Momo was because it came on my screen. I mean, when I did the screening, there was another company like SFL, for instance, that was there. And there was a few, but they weren't like great, well-known ones. But the idea was these are the really stocks that have beaten up, and bargain hunters come in, they do the New Year resolution, then they want to come in and just hopefully they're thinking that they're going to double this or triple this. I don't want to wait for that. All I'm doing is just taking their eagerness and hopefully greed to just make a little bucks. So that's what it is. So I think for me it's just one thing, and one thing is just the emotional rebound for the first 2 weeks of the year. It happened with Netflix and Bank of America. They just continued, so I had held some of them till like end of January. But other than that, it's usually the first 2 weeks is what you want to hope for. So, and that's why I don't want to buy one or two. I want to have a portfolio, and I don't want to buy, I just go directional. You can do that, as I said, vertical. I did some on Gilead on vertical, but it's again, it's just one strategy. If it's usually has been a winner, but you never know. I mean, but not all of them are winners. There's some losers in there too, but totally they've been pretty good.
So that means basically we can combine the criteria of target percentage of target with the timing. Like
yeah, it's more of a timing, Sean.
Oh, timing, okay.
It's all about, again, the second week of January. But you could do. I mean, it's just my natural tendency. I don't get into a trade without having my targets in there. I didn't think this would, because of the buyers came in like the last day on Thursday. Someone came out and there was like a volume spike, and so it just hit my target before I even had a chance to hit the first of the year. So, but I'm not going to complain. I mean, even if I made $10 or $20 or $100, that pays for New Year's dinner or something for one person, I guess. But the idea is this is more of a timing. So you give yourself till January 11th to 15th. If you made it, you made it. If you didn't, that's why I used the February. Because the pricing was better than January. But that's why I said you want to use either January or February. But most of the move should happen by January 15th.
Thank you.
You're welcome. Any other questions, comments?
Ramin, do you think the vote to approve the electoral college, all the talk about that's going around that, do you think that will have any effect on Wednesday when they go through it, or it'll just be a much ado about nothing because there's nothing really that can happen? It's just more of a show of politics.
Yeah. So Martin, that's one thing is I learned about politics not to predict it again. Basically, again, you have Tuesdays, the runoff too. I think that's a big news. As a matter of fact, the idea is for like 2024, this is a big thing. What if, let's say, the Republicans kept the Senate, and then 2022 you have the midterm? What if usually the ruling party loses? So what if it's so close that the Republicans take over the House? Then you have Democratic presidents, and now there could be moderation. There should be, and it seems like President Biden, coming President Biden, he might be one term because of the age or whatever it is, and he wants to leave a legacy. For instance, he wants to do a lot of reforms in a good way, and so the markets thinks about those things in a long run and say, and that's one of the reasons they say, well, maybe there will be some tough pain in the beginning, but the outlook is positive. These delegates, I'm not sure. I think the one thing I'm concerned though, Martin, maybe that could answer your question, is as you know, I look at the implied volatility quite a bit, and that's why I follow the VIX. But on the markets, on Spider, I was looking at S&P. The volatility is not subsiding till like January 15th or so. I mean, it's still for January. You would think we will have, okay, this week we have the big, expected move is about $90. The feel is there is this implied volatility that the markets are still a little nervous, and the skew, which I talked about last time, which is the premium paid for the 30-day put options, are much higher than the 30-day call options. So there's still a lot of hedging going on. So, but normally, Martin, it's do about nothing. I mean, it's pretty much set, I think. I think that the Georgia runoff is a little more important than, I mean, there was just these rumors, if you recall, I went to this gathering, they're saying, oh, December 23rd, something huge is going to happen. And the whole, there might be a military coup. I don't know. I mean, they come up with all these things. It's like selling newsletters kind of things. And nothing happened. I mean, the markets were on a ho-ho Santa Claus rally. They didn't care. But yeah, I'm not too bothered, but the volatility kind of concerns me. So, which is an opportunity. So hopefully if you have call options, that might be a good way of collecting your more premium on it. So, but yeah, I just watch it to see what we could do. Okay, Martin. Okay. Any other questions? Any comments? Any wishes? If you've come up with any suggestions, any ideas, I really appreciate if you can email me. That would be wonderful. And I'll come up with something for Tuesday. So I hopefully live, I think I will see you on next Sunday. And I'll wish you a wonderful, fantastic 2021. I look forward to again being with you, hopefully for the whole year, and for a profitable and healthy year, basically prosperous and definitely a much more successful year than last year. And if there's no other questions, I want to wish you a wonderful weekend, and I'll see you on next Sunday. All right.
Great.
Thank you so
Bye.
much,
Yeah, thank you,
everyone.
man.
Appreciate it. Thank you. Bye now.
Bye, I mean.
Bye, Sean. Thank you. Bye.